Hello and welcome to FXStreet Currency in Play. I'm Matt Brown. I'm joined by Ed Matts down the line from Matrix Trade. Good morning to you, Ed.
Morning, Matt. How are you?
Very well, thank you. Well, with no further ado, let's have a quick look at the major headlines and then we'll crack on. You've got lots of charts that you bought today and all very relevant. Just headlines, euro dollar stalls overnight, tepid recovery, move from 7-week lows. We're looking at dollar CAD bouncing off the 50 DMA support but keeps the red below 125 mark. And finally, the Japanese yen, early elections to decide the fate according to HSBC. But we're going to look at Ed's charts, and starting off with a cartoon, we've got Obama market and Trump market, with Obama there saying, how should we rotate this? And quite heavy-handedly, like this, Trump comes in with a sledgehammer. So what does this mean?
Yeah, cartoons as ever. Well, it tells a story. Essentially what we've done, or what's happened is, say, go back 5 years, the markets used to be well structured, they interrelated, bond market goes up, dollar goes up, stock market would go down on that scenario. And what we're seeing since then, since the election of Donald Trump, the market is increasingly broken, and it ties in with our view that we're in the last leg of a major bull market in the stock markets. Everybody keeps saying that. Well, we've now hit the targets, and now what we're seeing is the correlations, the normal order of things is breaking down. It's essentially a broken market. So what it's saying is everything now is about the stock market, and yet very little is about the stock market, because what's happening is each market is doing its own thing, because the market is now a sentiment-driven market rather than a fundamental one that hangs together, interrelated, or even the technicals are getting blown away. So it's almost a point now that you say, well, you take the last 24, 48 hours, Matt, you saw, first of all, you saw the stock markets ramp over the weekend. Euro-Swiss came down. That shouldn't happen. Euro-Swiss, Swiss franc should have weakened. Yesterday, you saw, again, the stock market rallying. The yen should actually weaken, and yet overnight the yen strengthened. So what it's saying is the correlations, it's a broken market, which makes things increasingly difficult if you try and join it all up together. But actually what it does, and some people will love to hear this, particularly technicians, is saying just focus on one market and what it's saying to you as a technician, as a fundamentals hard at this point, but what you're seeing on that one market. If you try and join it up, you're going to come a cropper, as this market not only is it broken, but it's increasingly volatile. Exactly what you should see. So the stock market is the context. We're in a massive blowout, and it's all about now getting people long. And we want to move to next slide, just to show you. Essentially what we've got here is people won't be able to see this, is we've looked at previous markets, bull markets, the last leg. Increasingly the correlations break down, happened in 2008. So don't be surprised what you're seeing now. It's actually or in fact that the market is rampant in the stocks. It's actually what you would expect, and it's extraordinarily exciting. It's extraordinarily difficult as well, but it's going to get increasingly volatile. And that's the great news if you can try and manage the volatility and manage the timing. Timing's everything in this baby. Let's have one thing we did in the last 48 hours, because this is now an important moment in the stock market. We did a poll.
But if we move on to this, if you just explain this poll, it's very interesting.
Basically, it's saying, right, we've broken to new highs. It's caught people, the North Korean bears, it's caught them out unaware. Bears are capitulating. What's interesting now is the bears capitulating. The market is necessarily longer because you've taken out stocks. But the question, Matt, and bear in mind, we're looking at what we think is a massive blowout, the very final pièce de résistance in this market. The question is it long enough? And that poll says it isn't, because what it's saying is a lot of people are standing aside saying, oh, wow, what's going on here? I can't buy it here. I can't sell it. It's too strong. What we need to see is the market say, oh, it's going up forever. And we're almost there now. We've taken a long time getting to this point, but we're not there yet. This is purely about sentiment, which is interesting going into ADP today, which should be an indicator, or arguably should be an indicator going to NFP on Friday, because a lot of people are predicating this on growth, on inflation, and therefore a higher NFP number, and yet we've got NFP that's going to be affected, or ADP as well, affected essentially by the hurricane. So we're looking at lower numbers anyway.
Understood. Moving on to the next slide, we're looking at the euro dollar, and you mentioned this sentiment gap on the 10-year differential, and it's still there. So obviously
it's still there, and the sentiment has driven this market. In the dollar market. The dollar market, curiously, this is unique. You know, we at Matrix Trade, we look a lot at history and try and work out, match the conditions, and therefore does the price action match. For the dollar to lead what we're seeing now is highly unusual, but it's what it's doing. And what we've seen, obviously, with the euro dollar, it's left the talked about the stock market leaving the fundamentals and the framework behind, and even the technicals. The euro dollars have been doing this for a while. You can see the sentiment gap. The blue is the euro dollar, well above the interest rate differential. In other words, well above the interest rate differentials is where it should be. Now, you could say some of that is risk premium associated with North Korean and the dollar, but that's gone. Yeah, so that differential should have moved in, and it hasn't. So it's saying there's an underlying long in this market that needs to be taken out, and we have to some extent taken out, but we haven't fully yet.
Understood. Moving on quickly to the next slide, looking at the supportive head and shoulders, again looking at the euro dollar. Briefly, where can we go from here?
Covered this last week, essentially saying that 75% of euro dollars head and shoulders, like DAX head and shoulders, are bought. In other words, there's a 75% probability play in favor of waiting for the head and shoulders to play out like it is, goes typically 75% as well of the move, but doesn't reach the head and shoulders target 75% of the time. That's 115.92. Now, we've made a new low. We were looking for a final new low, so that could be it. This is a correction, but still that differential is out there. We need that to come closer, we think, before the euro can get back into an uptrend, because it is, despite everything, still a dollar downtrend.
Understood. And quickly moving on, we're looking at after the German election. Obviously, that's still got to pan out. Just quickly talk us through this euro dollar chart here and where we can go.
Essentially, what it's saying is this has worked. Euro dollar German election. What the market does typically into and out of the German elections. It breaks down off on the election, comes back, rallies, sets a base, and then out of this base, it consolidates the base, it then rallies. The only point of showing this is saying this has worked and working, and now we should see the euro slowly but surely turn back up. Personally, as I said, I think there's too much of a debate, one about the head and shoulders. You've got the Catalan elections, people saying, well, risk off Germany. No, not, even though it's obviously important in Spain in terms of big picture European stability. It's not that big an issue in my humble opinion. But what it's saying also is that the debate should go on into NFP on Friday, and it's on the back of NFP that we think the euro will start getting volatile, or should consolidate into there before, as the election fractal shows, it should recover.
Yeah, and if we move on looking at the NFP, just talk us through, this is before and potentially after.
Yeah, something we do is, as you well know, Matt, is we look at any big event, because the events, not only do they drive markets' expectation and sentiment, but it also drives how they're positioned. And typically the market often not only reacts on the number in a consistent traditional manner, if you like, but it also tends to trade similarly before as well, and depending on how big the event. NFP is quite significant, certainly in an interest rate driven or a market that's focusing on interest rates, because they'll be looking to see whether it's a miss or a beat. And obviously today we've got ADP coming out, and that's going to be much lower because of the hurricane. I think they're marking it down from something like 236, 100 down to 125. The impact's much lower. What is interesting, Matt, is the difference between the expectation for NFP on Friday. Whereas the difference on ADP is something like 75k, the difference is only 25k on the NFP. So although the market is expecting lower, it's actually pricing in not as low as ADP. So ADP is, since 2012, when they changed the configuration of it, it's been a notoriously unreliable figure, but it will drive the market sentiment. So in other words, if it comes out higher than the expectation, which is a good chance because they've marked it down so low, then the market, the dollar should go bid. Stocks are going to do stocks will come off in terms of people being worried about the events, but people are going to try and buy it.
Yep.
We're now a buy-only dip mode, so as far as the market sentiment's concerned, so stocks will do that. Basically, what it is saying is on Friday on NFP, if it is a miss, it's actually going to. If the figure is a miss, as is unlikely given that they've marked it down, you'll see, for example, you'll see the euro dollar will rally, but they off, give us that final spike. And if it's a beat, we actually think what is neat about this, based on these are September, not general averages, is the market looks set to do the same thing, whatever. Mm-hmm. In other words, if it's a beat or miss, euro dollar will spike down and then start a recovery. In other words, people are getting a little bit overheated about the US yield recovery, and therefore it should see it unwind. So Friday promises to be a really volatile day. And not a make or break situation for the stock market. We actually think it will be the trigger to get into the final blowout, get silly, and then turn.
Understood. So briefly, we've obviously touched on the ADP. We're looking at the calendar, ADP employment change. We've also got, look out for the PMI coming out from the US later on. Draghi speaking and Yellen at the end of the day. But all eyes to the ADP first off, and obviously non-farm on Friday. But in the meantime, Ed Max of Matrix Trade, thank you very much for joining us today.
My pleasure.